Welcome to another exciting episode of Let's Talk Death Care with me, Babes with Death Care. Today we are at Momentum. We are talking all things life insurance and life cover. I am joined by Sibusiso Khumalo, whom I would like to give an opportunity to introduce himself and tell us more about the exciting things that he does here at Momentum.
Okay.
Sibusiso.
Thank you very much for having us. My name is Sibusiso Khumalo. Born and bred Soweto, typical Kasi boy. I currently work for Momentum Retail Life Insurance. I do product development, pricing, work very closely with our underwriters, sales team, the marketing team in terms of distributing our product to the end client via our financial advisors. And one day when I'm older and wiser, I'd like to look back and say, I made a contribution in the life insurance space by just simplifying the life insurance story, because I believe it's a bit complicated, and by simplifying it, we're going to open up the industry, and it's going to benefit both the shareholder and the end consumer.
Very true. You had me at simplify.
Okay.
Because in most cases, when we see these adverts on TV, you talk big terms, you talk a lot of, big jargon, and it becomes hard for people to understand.
Yeah.
So I'm really here to get us to simplify that languaging and to help, people at home to really understand what life insurance is about and the importance of life insurance.
Okay.
So if you could assist us, you could, definitely start by telling us, what is a life cover?
If you go back to start with just the basics, right? So you can think about it that every human life has an expense. So we all have an expense, right? But not all of us have an income, right? So that's just the basics. So we all need shelter, we all need, food, but not all of us can have an income to provide for those things. So you'll find that there's people who are financial providers in their household. And if it happens that that person dies or passes away, those that are financially dependent on them, they are left vulnerable. So a life insurance policy or a contract is a protection mechanism really to make sure that the people that you care about, those that are financially dependent on you, are in almost like the same position after your death as they were before. Obviously, from a financial point of view, we can't replace the loss of life or the emotional aspect of it.
Absolutely.
But from a financial point of view, we try to make sure that they maintain the same lifestyle that they've been exposed to by the income that you've earned whilst you're alive. So continuing that legacy. A good example would be your kids.
Yeah.
So they have a lot of expenses, but they have no income.
Yeah.
So when you pass away, you need to make sure that things like your education, healthcare, transport, all those basic expenses that you incur for your children will be covered by your life cover if it's in place. But if you ask, for example, if you ask a lawyer, they will simplify it and say it's just a contract between two parties, really.
Yeah.
There's a life insurer, life insurance company, and the policyholder.
Yeah.
And with any contract, it's an agreement, right? So the life insurance company says, if you meet your end of the contract, and I'll get to that now, I promise to make payment of X on the event of death, and that event is going to be specified on the policy, on the contract.
Yes.
Now, what does the policyholder need to meet in order for that payment to actually happen?
I think wait right there for me.
Yeah.
What I want now, as I think you've explained it proper when you had the financial hat on. The lawyers always confuse us. Now you're talking contract. I'm already scared. I'm thinking, every time it's in black and white, I'm in trouble.
Okay.
So I want to take us back to where you're speaking about a life cover being a replacement of me in a monetary form. Can you explain that? Maybe usichasele ngesizulu. What does that mean? Does it mean mangisebenza and I pass on, the life cover kicks in and then it pays the bills that I would have been paying if I was alive?
Yeah, so it's like I said, so the insurer is not obviously going to pay the bills directly to whoever you were paying the bills to. Okay. So what the life insurance company will do is that they will pay to the beneficiary that you nominate. So a beneficiary umuntu that you trust, that is close to you. In a typical family setup, kuzoba, let's say maybe your spouse, umuntu ozwana naye, and that's if, let's say, you want to protect your kids, as an example. So you trust your spouse because the interest is the same. No two nifuna abantwana bakhule kahle.
Yes.
So what will happen is your spouse will then get a lump sum of money, and then you trust ukuthi they want to use that money to make sure ukuthi they pay for the school fees, they pay for transport, they make sure there's food for abantwana, there's food for the household. Because when you pass away, unfortunately, life iyaqhubeka.
Yeah.
Right. So like simple things like your electricity bills, they need to be paid. Your water, your rates and taxes, all those things that maybe we take for granted, all those things need to continue being met by some form of payment. So life cover kicks in, pays the beneficiary, and the beneficiary uses the money to ensure that those expenses are met, that you were responsible for. Sapil.
Thank you for that. And I think you've touched on a very important subject that has a lot of people confused.
Okay.
What is a beneficiary, or who is a beneficiary, and how do we select a beneficiary? Because some people would then say, because I want my child to benefit and she's 10 years old, can I select a 10-year-old to be a beneficiary?
Yeah. Okay, South Africa, so you can't nominate a minor. A minor is a child who's younger than 18. So 18 years and younger, you can't nominate them as a beneficiary.
Yes.
I mean, you can imagine giving a 15-year-old like millions of rands. They'll just blow it, right? So you can't nominate a child as a minor. So like I said, you start with someone who's close to you, who you trust. So it can be a spouse, it can be maybe your parent, because for some of us, for example, in our culture, we also look after our parents.
Yeah.
So you can nominate multiple beneficiaries on your policy, depending on who you want or you were looking after financially. So I'll give you a scenario. So if I was, if I'm from a family where it's myself, my spouse, nabantwana bama bayi-2, and then but I also look after umama and my siblings and my cousins and all those things, I can literally nominate all those people as beneficiaries of the policy. So if the policy is paying, let's say, $1 million, I can say 50% will go to my spouse, which means 500,000 will go to my spouse, 25% to my kids. So that's the 250,000 to my kids. The other 250,000 to my mom, for example. So it's up to you who you want to nominate as a beneficiary to your policy as a policyholder. And those are the people that typically that you are looking after financially. But for kids, let's take it a step further, because like I said, you can't nominate umntwana as a beneficiary. So what people nowadays do is they set up a trust.
Yes.
So for example, a company like Momentum Trust, you can set up a trust. What the trust does is the trustees work hand in hand with a guardian. So you will nominate a guardian. If your spouse is still alive, they're likely to be the guardian. But if something horrific happens in Shonani to, for example, in a car accident, I'm a will, for example, you nominate a guardian. That guardian will work very closely with the trustees to make sure with you all the needs as umntwana they are taken care of. So that lump sum money, that 1 million, it's put in a trust. Let's assume they are 15 years old, for example. Up until they get to the age of 25, when they are of age and they are able to manage their finances, it's going to be under the trust. But it doesn't mean during this period, before they turn 25, they don't have access to the money. Yes. So a guardian or a court trustees, you can nominate a court trustee, and they can work with the trustees to make sure that things like education expenses, any need really that a guardian says, okay, umntwana needs something, there's a school trip. To overseas or something, like you can contact the trustees. They give you the money to make sure that those needs are met. Until it gets to a point where they turn 25, there's a balance. So it was, say, 1 million now, 500,000. That full 500,000 becomes accessible to now that child who's now an adult. And I think that's it's a concept where we say people almost like want to rule from the grave.
Yes.
So
yes.
Bafuna, like and I think it's almost like a responsible thing to make sure you don't give them access to the full money
Sure.
whilst they are not able to use it. You give them enough time, but with the ability to have a trust company that you trust, which will ensure their needs are met,
taken care of
until the point where they can make their own decisions.
I like the concept you're introducing of trust, because even if a person is of age and they are 21, giving someone 3 million rands who's never even had 30,000 in their bank account is disastrous. I mean, we've seen it on iProot. A lot of people blow this money. So I want you to, explain to us, do we open up this trust when we're taking the policy, or is it after? At what point are we able to open the trust so that we safeguard that money? Because to what you said, the whole point of taking a life cover is to ensure that the ones that are left behind don't suffer. So to again, rule from the grave, you want to make sure that money lasts quite a long time for your family. So at what point do we open up these trust accounts?
Okay, so the trust that I'm referring to is called a testamentary trust. So just I'm asking Zulu things.
No, it's fine.
It's a trust that you set up in your will. So
in your will,
you specify in Mangshona, I want company X, which you nominate as your trustee, to open a trust for Mtwanami until they get to age X.
Yes.
Right. And there's usually like three almost like types of trust, or common ones. It's for the children, children's trust, but some people also do it for their spouses, called a widow's trust. So all of these are testamentary trusts set up by they're evoked by the will. A widow's trust. That one is, so you have your wife. It's the thing, maybe she's not that financially sophisticated. And you don't want them to get that 5 million as a lump sum. You want maybe for them to access it in like monthly installments or something like that. But the other reason why people do it is because Sibusiso Nothabi bashatile, Sibusiso yashona.
I get another man who comes and steal this money. Which is great.
So people try and prevent that, because what then happens is you set up a trust in such a way that, my spouse is going to benefit, but if it happens that she remarries or we are shorna, then it goes to my kids. To prevent lento yokuthi kungena uJoe manje seka kick out abantwana, now there's no longer all the work that I did, all the legacy that I wanted to leave behind is now being enjoyed by someone else. So trust, I think, will protect from such situations. And then the other one, the last one, is trust for people with special needs.
Oh yes.
Or who need special care, let's say you have a child with special needs, you can set up a trust for them as well. So they are a beneficiary of your proceeds of your life cover.
Yes.
So instead of them, because they are not in a situation to actually handle financials themselves. We set up a trust for them. So those are the three common types of trusts that people usually set up to take care of or to rule from the grave.
Amazing. And it's actually the first time I'm hearing about a widow's trust. Can you believe? I think it's a great product, considering that there is actually an entire scam of men out there that are trying to scam widows. It's ridiculous. It's a different scam of its own. But thank you for that. And then that leads me to my next question of, how do I know I am appropriately covered? How do I know my life cover is going to be enough to last my kids for a long period?
Okay, so that depends. Ne? So let's start with the easy one, for example. And this is where I want to emphasize the importance of having financial advice.
Yes.
Right. So because financial advisors, one, they see a lot of different scenarios, right? And they can tailor your plan specifically to your needs. So this is where I need to emphasize the need to have a financial advisor, also Kulumanai. But we can simplify it using simple numbers. So if you earn, let's say 500,000 per annum, and going back to that fact, Yoguti, there's people who are dependent on your income. So let's say 80% of that is what you spend on yourself and your household and abantu that depend on you.
Yes.
The other 20% is what you use for groove. Maybe some you save, buying yourself clothes and everything. So that 80%, what is it? That 400,000. Now the next thing is, if you take life cover at 400,000, it means you've only left them income for a year.
Sure.
So the next question you need to ask yourself is, okay, for how long do I want a protection for my, say for my kids or for my family that I care about? I think you can, to be on the safe side, you can use the age of your youngest kid. So let's say they are 15 and you think they'll be independent again at 25. So that's what, 10 years. You take that 400,000 multiplied by 10, that's 4 million. So that could give you an indication when you're having a conversation with a financial advisor, you have an idea of okay, so this is the income that I actually want to replace when I die.
Yes.
But it's not only the income, so that's one, right? So income you can estimate it like that. It's okay, I need 4 million based on how much I currently earn.
Yes.
But there's other things. So if you have a mortgage, a bond,
yes.
You don't want to get to a situation where when you pass away, people are kicked out of the house because the bank is repossessing it.
Yeah.
So you want to take out life cover that will be enough to settle that bond. So if there's outstanding debt on the bond of 1 million, so that's an additional million. So 5 million manj. Things like and this one is something that I think we'll probably need another day to discuss the estate planning, because there's cost in dying. So things like executor fees, property conveyancing fees, like the fact that you're leaving a property with someone, there's transfer cost that needs to be done. Those things can eat up to like 5% of the estate that you leave behind.
Yeah.
So if you don't take care of those expenses, you might end up actually leaving less than what you want to leave out for your kids. So that 5 million in Kulumangaya, maybe it's now sitting at 6 million.
Yeah.
But these are just numbers to give you an idea, and for your consumers to just think about these things using income, their debt, but also lastly, the future goals that they have for Abantwana Babo.
Yes.
Because, I mean, I think there's tools these days online where you can estimate the cost of education that you expect to pay for over the next couple of years. You need to include that, because more sure you want to make sure there's enough to make sure Abantwana Babo could receive the education that you wanted them to receive.
Absolutely. Thank you so much for that. Because I think the most important thing you've just mentioned is that there is a science behind taking an amount of a certain life cover.
Yeah.
And that is what a lot of people don't understand.
Yeah.
Because just like you've mentioned, that in terms of raising your kids, you could be spending 100,000 Rand per year and you're taking a life cover of 500,000. It means that you've bought your kids, what? A good 3 years if you're adding all the other things like the bonds and stuff.
Yes.
So you don't want to be running at a shortfall, because at that time you won't be there to actually fix it or, try to source more income.
Exactly.
So you need to make sure that they're actually quite secured, which is quite a great input on your end.
Yeah.
Now,
but it's also, sorry, before you continue, it's also important to emphasize two things, right? So you might find that if you want to protect them for 10 years, for example, that it becomes too much or expensive.
Yeah.
And then someone will be discouraged and say, then I'm not going to take but I think it's better to have some cover.
Yes.
It's better to have a protection, let's say, for 3 years, than to have no protection at all.
True.
So that's number one. The second one is, without financial advice, you might run into a case where you actually over-insure. Right, so
which is
because
quite dominant.
There's also that element, and over insurance is bad for you, but also for us as insurers, because let's say now, for example, you need that 5 million as a calculator, and then when you end up taking 20 million, and Sibusiso beneficiary.
Yeah.
There's two risks. So Sibusiso, it's either uzokubulala.
Rosemary.
Yeah, exactly. So Sibusiso will try to kill you so that you can benefit from that.
Yeah.
But there's also potential for fraud.
Yeah.
When you overinsure. So so people just need to, like I said, I think let's emphasize this thing. I think more in financial advisor, because they've seen the stories from policy inception up until they deal with the claim. So they can relate. And I strongly believe when you speak with a human being, it's better because they can also see the reaction in your face when you talk about your kids. For example, lights up. Okay, so this is important for Utabi. When you talk about your bond or your house, they can tell okay, this is important, and they can tell your plan towards that.
Yeah.
I'm not saying there's you can't do it. There's people who can do it themselves directly. To get life cover directly, it's possible. But I strongly believe that financial advice will make sure that your plan is watertight.
We are definitely aligned because there is a lot of, we live in an information age where we find information almost everywhere, but we sometimes fail to validify that information. We find a lot of people on TikTok talking a whole lot about how people can run away from probate, how they can run away from financial planners, they need to DIY. I personally am against DIYs because you need a professional to guide you through the process, and you are spot on in terms of having a close relationship with a financial advisor as well as an estate planner, because these two things are interlinked at some point. So we've spoken about the nice stuff. I want you now to tell me, what are some of the exclusions when one takes up a life cover?
Okay. Why is that not a nice stuff?
It's not nice because a lot of people don't read the document, and at claim stage, they find that in actual fact, they are in contradiction of an exclusion that was stated there. And then now we get a whole cancel culture on Twitter that says, Momentum did not pay. Momentum, but did you read your contract? Momentum did state that should you pass on to, for example, I know this one exclusion, that is, should you commit suicide within the 12 months of your policy or 24 months, then the insurer's they're not going to pay.
Yes.
So you find that your loved one commits suicide, now you're wanting to claim, and you are being told you cannot claim.
Okay, no, that's true. And this then goes back to that point Lebeng raised about contract and lawyers, and you said it becomes because that's where now it starts to play. So like I said, I mean the end of the contract that the consumer needs to meet is the simple one of making sure that the policy is enforced by paying their premiums.
Yes.
But the second one, which is the most important, is just don't lie when you're taking out a policy. Because then that contract is based on a lie, and it almost like becomes null and void, right?
Yes.
So the common exclusions, the one that you touched on, and we're talking death exclusions now, right?
Yes.
On the death benefits, it is suicide, and it's typically within a term. For us at Momentum, it's within the first 2 years. So if you commit suicide within the first 2 years, then we will not pay, and it's part of our exclusions. And that's the only general exclusion that we apply on our policies. And I'm very passionate about this one because when I joined Momentum, I actually perused our general exclusions and made sure that we exclude things that are brought about directly by a client, not things that. So you'll find that some insurers, for example, will exclude a death if it's caused by an explosion, a mall, and you found yourself a mall,
you're shopping.
Exactly.
Yes.
And the argument is that's not something that is in your control.
Yeah.
Right. So what we try to exclude, it's things that, and this just trying to stick to the principle of insurance.
Yes.
Which you must not cause a claim. You must not do something that will cause a claim, right? Because then that's not insurance. That's you taking advantage of the situation. So if it's something that the client deliberately does, for example, I'm just going to quickly jump into, let's say, disability, where they deliberately self-inflict injury, where there's proof. For example, let's say Katomuno, and we somehow find proof this person did that. That's something that's going to be excluded because they deliberately doing that to try and claim. But on the life side or on the death benefit side of things, the main exclusion really is is suicide within the first 2 years.
Yeah.
Sometimes some insurers exclude like death caused by participating in dangerous activities.
Like bungee jumping.
Yeah, I don't want to be specific which one, because they do specify in their contract.
Yes.
So we don't have that on our death benefit. The other one would be like pre-existing conditions.
Yes.
Conditions that you had before taking out a life cover. So let's say what example can I use? I don't know. You have some condition.
With diabetes.
Yeah, you have some condition and you don't declare. I have condition X. So if you happen to die because of that condition, and you didn't disclose it, but it's also within a period. So let's say this condition was diagnosed 3 years before you took out your policy, and you die of that condition within 3 years of taking out the policy.
Yes.
Then it might be excluded as well.
So I want to. Just on that, because I had a lot of conflict on Twitter and people going raged because there's an incident and it does not specifically has to be tied to momentum. This would just be the life space.
Yeah.
Where someone did not declare that they had diabetes and then they pass on due to a car accident.
Yeah.
Some insurers would not pay, right? Can you explain that from maybe is it an underwriting perspective or is it a policy? Because from my understanding, when I had an engagement with someone, they said the problem is that you lied on the application.
Yeah.
It's not necessarily the fact that you've died because of this accident, because number one, some insurers don't actually cover that illness that you had.
Yeah.
Or number two, you would have paid a different premium. So the fact that, yes, you had diabetes, you did not declare, but you died due to a car accident.
Yeah.
If we do find diabetes, then you still, went above the contract.
Yeah, that's why I started with it's a contract and it should be based on both parties being honest at the outset, right? But life insurance contract they evolve over time, and then obviously we also not static. Right, so we also listen to what people say out there, and then we respond to that, because we also had, I think, a similar incident, and then we ended up, responding and making a payment based on the fact that it's just a reflection on the fact that you can't have rules that are static and not respond to the changing requirements of the society. Yes. So you have to be fluid as an insurer, and it's a very difficult space, because if you end up paying all those claims, and I'm going to give you an example now. If you end up paying all those claims where people lie, what's going to happen is that the guys that are remaining in the insurance pool are going to end up being charged a whole lot more than what they should be paying for. Because they will be subsidizing those guys that are lying, right? Sure. So it's not just for the benefit of the insurer, but also for the public as well. If Soloko species then it means in future, because we're going to have to reflect on the experience, we're going to monitor the experience, and it's going to impact the future premiums. They might not be able to afford life insurance because of those things. Sure. So you have to be fluid, have to respond, and social media will put pressure, and sometimes you abide, sometimes you don't.
True. And I think I like what you said, and I want to mention this because I think I've mentioned it before. Each and every financial product serves a certain purpose. Now, when we decide to enrich ourselves by committing fraud, we are making the system even harder for the people that are trying to get into buying these financial products. And then 2 last questions on my end.
Okay.
I want to understand the claims process.
Yeah.
How do you simplify that process for the customer? What are some of the things that a customer needs to know and needs to have ready at the time of claims? And the reason I ask this is because I'm also I also have done this myself.
Yeah.
Where I get excited about a product, I don't even ask, how do I claim? At the call and the policy inception, I only care about how much am I paying and what value am I getting. Yeah. That's it. Never asked, how do I claim? It is only when I need to claim.
Yes. Okay. We can try and simplify it in it's basically three steps. So the first step is obviously the notification. You need to try and you need to notify the insurer of the fact that there's death. So if the policyholder and the life insured, so the policyholder is the person that owns the policy.
Yes.
The life insured is a person that whose life we're actually insuring. With Marashona,
Yes.
so now, if they are different, because it can happen, most of the cases the same person, but if they're different, so the policyholder can make a call and notify the insurer which there's death.
Yes.
And typically on death benefit, the main thing that is required really is a death certificate. So that's the notification part.
And a BI form.
Yeah, so that's the notification part. So that's the first step. The second step is now on the insurer's side to verify.
Yes.
So that's where now we actually check if the policy is active. That's the first thing that we check. We check if there's no specific exclusions that we applied in underwriting. Because for some people, because our product are underwritten, which means it's almost like you can see it as gatekeeping. So we assess the risk before see Vumelu, right?
Yes.
And some people we might accept them to the pool, but with an exclusion. Let's say you've highlighted that you suffer from like back pains or chronic pain, something like that. The insurer might say, okay, it's fine, I'll give you cover, but I will not pay if your death is caused by the exclusion X. So you check those things, they verify, they do all those verification. And if everything ticks, it's fine, which is normally the case. For Momentum, 99% of our claims are valid, we pay them. Then the last part is literally just contacting the beneficiaries and making sure that we pay them the money that is due to them. So some of the payment, for example, in our debt space, we pay about 10% of the sum assured, or up to 50,000 within the 2 days of receiving just the claim documents before we even validate the claim, to make sure things like funeral expenses are covered, those immediate expenses. And then after that, but receiving that payout doesn't necessarily mean that your claim is valid.
Yeah.
Exactly. So we'll still validate it. And then if everything goes according to plan, the last step is basically to just make the payment.
Fantastic.
So those are I hope I simplified it, but those are the three steps to follow to lodge a claim.
No, you did, which is very much important. And I think we're having a conversation earlier on just around how important documentation is. Because a lot of people even live around without knowing where their ID is.
Yeah.
When they pass on, you need to go through push and hoops and trying to, getting the right documents. But I want to take you back to something you mentioned before. You spoke about the fact when we were doing the analysis around how much coverage one would need.
Yeah.
Some people have asked, can I have my life cover as a surety for my bond?
Oh, yeah. Okay, yeah, no, I mean, that is doable. In fact, with most policies, you should be able to do that. But again, it's important to go through your documents, because some providers or some policies will specifically tell you that no sessions are allowed. But most of the cases you should be able, and it's mainly for mortgage bond protection,
yes,
where you say, when I pass away, and sometimes it's actually a requirement from the bank itself.
Oh.
You need to have life cover in place.
Yes.
In the event that Moshona, they need to pay us directly to settle the bond. So definitely, it's doable. You can do it, and I'm not sure what else to add there, but
no,
it is doable. But it's important to just check your documents and make sure it's allowed by your particular and specific policy.
Specific policy.
Yeah.
Which is fantastic, because some people would asking, so if I have a bond cover, do I then still need to take up a life cover? And you clarified that there are other expenses apart from a bond that you need to take care of.
I think that's also where we were supposed to start a bit, because when we're talking about a death benefit, so a death benefits have existed for a very long time.
Yes.
And what we're seeing now in the market is that it's just different packages of death benefit. So a funeral is nothing but a death benefit, right? It's just packaged specifically for that need of covering funeral expenses. Now, a bond is also just a bond cover. Like you say, it's also just a death benefit, but it's packaged specifically for bond protection.
Yes.
Whereas someone else, if you speak to your financial advisor, who does holistic financial planning, will identify all these things that you need a funeral expenses covered, you need your bond covered, you need education covered for your kids, and then just give you a single lump sum to protect all these needs. So when you say bond cover, when you say funeral cover, you're just talking to a specific package of a life insurance policy. But at the end of the day, they're all life insurance policies, and the things that may cause them to differ is things like the term of the policy.
Yes.
So, for example, a bond cover, you wouldn't expect that to be for whole of life. So, whole of life is when an insurer makes a promise to they will pay you whenever that death occurs. It doesn't matter. Whereas a bond cover, because they say your bond is for 20 years, it will only pay if you die within the 20 years. So after 20 years, that falls off. If you don't die within 20 years, there's no payout. Because it's for the bond.
All right.
So even with some, I guess, funeral policies, for example, if you're adding your kids, they might protect them up to a specific age.
Yes.
So that's also a term cover. So in broad term, the way to think about it is there's term life insurance, and then there's whole of life insurance. So whole of life will pay whenever the death occurs, and term, they will specify a term either via age or specific number of years. So it's between 5 or 25 years. And if you don't die within those that period, there's no payout that's going to be made.
Okay,
And people usually take that because it's cheaper than whole of life.
Okay, wait. So you're telling me that I can take a life cover up to, for example, the age of 65. Should I continue and be 66, 67, I'm no longer covered?
Yeah. If the term of your policy is up to 65, or if your term of the policy is 20 years, if you don't die within the 20 years, then there's no cover.
And what happens to my premiums?
If you had died, you would have received a benefit.
If I'm alive?
There's no payout.
Sure. That's a very important one. I think you need to catch that. You need to catch this.
No, because so how do I say it? Because
this is very important because it's the first time I hear of it, and some people might take term covers and they're not aware.
Yeah, that's why it's important, because term cover is good for just from an affordability point of view. And then what usually happens is that at the end of the term, people will have an option to extend their cover. So let's say I'm still young, right?
Yes.
I'm still young, I'm still healthy. I take out the policy, and because I'm young and healthy, it's cheaper. Because it's cheaper when you're young and healthy. You get into it, you take term cover, let's say for 20 years, because the only thing that you have really, maybe it's your bond, and you want to protect that.
Yes.
Right? And then you get to, at the end of 20 years, then you'll be given an option to extend that, maybe for a further term or for whole of life. And you pay a premium for that. Then you'll have cover for the rest of the policy.
What an eye-opener. Thank you for that. Last question, last one, literally last one, and thank you so much for your time today. So I wanted you to assist us in knowing. So I understand that at the time of my passing, there would be costs, there would be things that still need to be taken care of. How do I fully cover my family? What sort of products? I heard you earlier on talking about the education plan if I have kids. What are some of the products or investments that I need to look at in ensuring that that financial burden does not exist for my family? Okay,
so now I'm going to speak to the product that I know, that I work with. So from a Momentum Retail Life point of view, so what we've been talking about is the protection side of things. So protection means you pass away, we pay. The other product in the protection space is things like your disability. So because people, you are investing, you're saving money, but we fail to plan for the fact that things could happen, and you might become disabled and lose your ability to earn the income that you're so dependent on.
Sure.
So your income protection benefits play a good role there, because they replace your income in the event that you can't work. For example, so a good example, like for my profession, all my work is in my head. So if I go, I won't have an ability to earn an income.
Yes.
So I have a policy in place now that will pay, so but things will right financially, things will be taken care of for a family. So that's income replacement. But on the disability space, there's also versions where it's a lump sum payout. Those ones are typically good for lifestyle adjustments. So a good example is, let's say you get involved with a car accident, and then you wheelchair, but because in stairs, you might need renovations to your house to accommodate a disability. So life insurance is good for that. It will make a payment. So those are products that we call living benefits. The other one is critical illness cover, and I think it's becoming popular now with the talks around NHI and all those things. So critical illness will pay a lump sum in the event that you become diagnosed with one of the listed critical illnesses. So the common ones is things like cancer. So cancer actually makes up 50% of, close to 50% of the claims.
Sure.
So it's cancer, it's things like heart attack, your stroke. People use the payouts there for things like maybe seeking medical care if the medical aid, let's say, runs out. So it's important for me to highlight that it's not a replacement for medical aid.
Medical aid,
so you still need to have your medical aid, but it will ensure that, for example, if you've identified a specialist outside the country where you believe they can treat this critical illness that you're diagnosed with, you can spend that money for that. But it could also help as a form of income replacement, because you can imagine if you just get diagnosed with cancer, you don't want to be dealing with that diagnosis plus the financial stress.
Sure.
So you might want to maybe take a break a bit from a whole lot of things that you need to do to earn a living or to make an income. So critical illness is a very important benefit to have, and we see in our numbers that people are very underinsured when it comes to critical illness. So it's very important to think about that one. And then there's also like savings or life insurance savings product. It's called an endowment product, because you see, we've been talking about what if I die? And it's not really debt that you're protecting against. It's untimely death. It's unexpected death, right? But there's also a risk of surviving, or and it's funny to call it a risk, but it is a risk, because you could live up to 90, and if you didn't save for retirement via my endowments or via your retirement annuities, you could end up being a burden to abantwana family. And the I don't see them, looking after us. In the past, it used to be the case. After retirement, abantwana bami bazonginakekela. But yes, I'm not sure about the generation that's coming, if they're going to be willing to
definitely not take care.
They're going to be willing to take care of us. So you need financial assistance for that long-term savings element as well, to protect your standard of living. Right. And I think that's about it.
Thank you so much. Again, Sibusiso Khumalo from Momentum. Thank you so much for sharing so much knowledge. I mean, there's always an opportunity and room to learn. I didn't know half of the things that were mentioned here today. Okay. So you can see that it's always best to speak to a professional. So Sibusiso, what advice would you give to the people at home who are looking into, buying a life cover or interacting with any financial products that would secure them and their family at the time of their passing?
I think the main thing really is to seek help from an expert, someone who deals with these financial plans on a daily basis. That's the financial advisor. Because uSibusiso noThabi bazokutshela their own stories or their own theories. So I think because I'm not a qualified financial advisor, so I can't give financial advice. So it's important for someone to sit with a financial advisor and ask these questions and ask them and actually tailor it to your unique circumstances. Because we talked about financial dependence, abantu dependence. For example, in our culture, we have different dependence than other cultures. So for us, it's our kids, our spouses, our parents,
the whole
our
neighborhood.
Siblings, ikasloke basically. So it's important to seek a professional advice. And if you decide to do it yourself afterwards, but at least have someone to speak to initially, I think that would be my 2 cents advice on that.
Thank you so very much.
Thank you for having us.
It was lovely having you, and we do look forward to sharing the content and people engaging with the content. It has helped, I think, a lot of us in this room understand a lot of things, and it will greatly contribute to the people out there.
Okay, thanks. Oh, and lastly, I told my 7-year-old Uti, I'm doing a YouTube thingy today, and he said I must not forget to tell people to like and subscribe.
Oh yes, please, yes, please.